Welcome, guys, to the most sauce in a single YouTube video that you're ever going to find. A lot of people will teach you their actual model, right? Their mechanical model, something like that. But nobody ever talks about their discretionary model. Once again, I could be completely wrong. If somebody does talk about this, please let me know down in the comments. But this is going to be my take on how I trade discretionarily, right? Because if you've heard anybody talk about trading before, if you trade a mechanical model for your entire trading career, you will not be able to make it, right? You can start trading mechanical model now and follow the strategy and you'll be good for maybe like a year or two, right? But then after that, you're going to have to start adapting, start trading the markets how they should be traded, right? And that's through adapting and through using a discretionary model. So I'm going to attempt to teach you guys my discretionary model. Don't know if this is going to work or not because obviously it's discretionary how I trade, but I'm going to talk about my thought process, what I'm kind of looking for when I'm trading discretionarily. Okay, so there's a couple different things we're going to talk about. We're going to go through the entire 5-step process essentially that I go through when I'm looking to trade, right? And this is going to be complete raw footage, no cuts, no nothing like that, right? Me talking to you guys. So pardon my mistakes or anything like that. Anyways, let's get right into it, right? So first of all, with my discretionary model, how I'm trading discretionarily, right? I like to have 5 things, okay? And you'll see that they're in this order for a reason, okay? I'll tell you why they're in this order for a reason. Okay, so firstly, right, I want to see a high time frame reaction, okay? After that, I'm going to determine my higher time frame draw on liquidity, right? Then I will see a low time frame retrace. Then after that, I'm going to determine my lower time frame draw on liquidity. Then I'm going to enter a trade, okay? Now, the reason I don't have determined draw on liquidity first, right, is because you want to see that higher time frame reaction first, right? Your higher time frame reaction gives you what you need to determine your draw on liquidity, right? So obviously we're going to go through examples and all that, but if we're seeing, right, a 4-hour bullish gap getting respected, therefore, I'm going to look to target something long, okay? Then I'll determine my draw on liquidity. If I'm not looking for my higher time frame reaction first, how am I going to know where we're going to go, right? Then how do I determine my draw on liquidity? So yes, the first thing in the overall whatever, right, is your draw on liquidity, okay? If you were to boil it down to the simplest terms possible, it's draw on liquidity, 5-minute retrace, and then enter, okay? That's literally all you need, okay? But this is a little bit, I don't want to say complicated, but more in-depth, okay, of exactly what that means. So first off, you're going to find your high time frame reaction. Then you look for your draw on liquidity and higher time frame, right? We're going to go over examples of what that could be, okay? Then after that, once you determine your draw on liquidity, now you look for your low time frame retrace / reaction. Could be same thing, right? A reaction. Then you're determining your lower time frame draw on liquidity. And it's the same thing with the high time frame to low time frame, right? You're using that retrace, that reaction to determine where we are going to go, right? And you're aligning those time frames together. You're putting them together. Okay, it's got to be the same way. If your higher time frame saying you're going long, your lower time frame saying you're going short, right? You're not going to take that trade, obviously. Okay, so you're going to align them together with where you think that we're going to go in the higher time frames with the lower time frames, right? Then after that is going to be your entry. So we're going to go over each and every one of these steps, kind of go over how I'm thinking, how I go through it, everything like that. So first off is your higher time frame reaction, right? And this can be a couple different things. This can be a 4-hour or a 1-hour fair value gap, which is most likely what I'm going to be using, right? I'm going to want to see a reaction off of a 4-hour or a 1-hour fair value gap, right? Now, it doesn't always have to be like this, okay? One of my students had a question the other day. They hit me up and they said, you know, like, I saw that we went short after we were delivering off of a bullish 1-hour gap. Like, you know, was that not a good idea for me to go short? Like, was I right for sitting out? Like, yes, it doesn't follow the specific strategy that I teach, right? But that's where you become discretionary, right? That's where you flip your bias and you say, okay, you know, we aren't delivering off of some sort of gap, right? But we have a high time frame liquidity sweep. We have a high time frame SMT. We have a new week opening gap that we're delivering on, something like that, right? So it doesn't always have to be one of these, okay? It doesn't always have to be a 4-hour, 1-hour gap. It doesn't always have to be blah, 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 right? We're going to talk about stacking confluence a little bit later to give you better trades, okay? But it's got to be one of these, right? We could sweep this liquidity, target something long, right? We could have some sort of SMT off of that, right? Could be just tapping into a gap, right? And that's essentially all it is, right? That's your higher time frame reaction. Now, whatever happens off of any of these, right, that's going to help us determine what our next draw on liquidity is going to be, right? And that's number two. Number two is going to be determining your higher time frame draw on liquidity, right? So obviously we see that we're reacting off of a 4-hour gap, right? Well, now we're thinking, okay, we're probably going to go long off of that reaction, okay? So we're using this same thing. We're reacting off of this gap. Now we determine where we're going to go. We know which way we're going to go, right? Now we determine where exactly we're going to go, right? So what is your draw on liquidity? Your draw on liquidity is going to be a 4-hour or 1-hour fair value gap, right? It could be this bearish gap because we're thinking that if we are going to continue back up, we will trade towards this gap, right? Could be a high or a low. Maybe instead of this gap, you think, oh, we're going to push all the way up to here, right? Then you determine that's your draw on liquidity. Or it could be equilibrium of the range, right? It could be equilibrium from here to here, right? If you guys don't understand draw on liquidity, you don't understand equilibrium, stuff like that, I have other videos on my YouTube channel. Go check them out. I have one over equilibrium. I have one over SMTs. I have one over liquidity, right? Go watch those first. This is for more advanced traders who know the confluence, who know exactly what I'm talking about, right? This is not for beginner traders who are just looking to find, the first original steps into getting into trading, okay? This is for advanced traders who know each and every single one of these confluences and these PD arrays in and out, right? That's who this is for, okay? So if you don't know any of these, go watch videos on those first and then come back to this video and continue watching, right? And this is gonna be the same confluence as your high time frame reaction, right? Our high time frame reaction was a 4-hour gap, right? High time frame reaction could have been liquidity sweep, which is a high or a low, right? Could have been a new week opening gap, which is the same thing we have here, right? So obviously you can see that determining liquidity, we're essentially targeting points that we could reverse off of, right? And that's where we're going, because we could come back up, reverse off of this, go down, right? Reverse off of this low getting swept, blah, 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 so on and so forth, right? So we're using different PD arrays as our draws on liquidity, okay? So now you've determined our higher time frame reaction, okay? Now you've determined where we think we're gonna go. What's next, right? We wanna get the best entry possible, so we find a low time frame retrace, right? We could just enter off of this. We could see a high time frame reaction and have a draw on liquidity, and then boom, we enter, right? But we wanna be precise. We wanna have the highest and the greatest probability of this trade playing out. So what do? We wait for our lower time frame retrace, right? And this is going to be the exact same as our higher time frame, the higher time frame reaction, right? It's just in the lower time frame. So instead of a 4-hour and a 1-hour gap, it's a 5-minute and a 15-minute gap, okay? So we're waiting for one of these to form. We wait for us to tag back into this, okay? This also could be a low time frame liquidity sweep. We could come down here, sweep some low out here. We could sweep a low out in here, right? We could have an SMT, right? We could have equilibrium with this, okay? These are all things that we're trying to determine where price is going to go, right? So we're using each and every single one of these, stacking our confluence, saying, okay, we're inside of a 5-minute gap, right? We just retraced into equilibrium. This looks like it could be pretty good to continue back to the upside, right? But we're not going to enter off of this, okay? But like I said, okay, this is what we're using to get the best entry possible. From the higher time frames all the way down to our entry is us crafting a narrative for price and crafting what we want to see happen, right? Getting the best entry possible and then entering that trade, okay? So number 3 is going to be low time frame retrace. Find some sort of retrace. Find something that is giving you the idea that, yes, we are going to go back in the direction of that higher time frame draw on liquidity, okay? Then after that is going to be number 4, which is going to be determining your lower time frame draw on liquidity, right? Obviously, you have a higher time frame draw on liquidity. In this scenario, let's say our higher time frame draw on liquidity was this high right here, okay? That's our higher time frame, okay? Now we're looking at low time frames, okay? What is going to tell us and what is going to give us more probability that we're going in that direction, okay? We have a high time frame DOL. Now we want to see a low time frame DOL, and this can come in a couple different things. Once again, we can target a 5 or a 15-minute fair value gap. As you saw with the higher time frames, those drawn liquidities can be fair value gaps, right? We could target a 4-hour or a 1-hour fair value gap. And that's mostly where it's the same. Everything else in the lower time frame is essentially different though, okay? Because we have things like low resistance liquidity, right? If you guys don't know what low resistance liquidity is, go figure it out in a different video, okay? Like I said, this is not for beginner traders. We can have something like low resistance liquidity. We can have something like equal highs or lows. We can have a data wick, right? We could have equilibrium of some sort of higher time frame range, right? those are going to be things that are going to be our lower time frame DOL. And then we're stacking that in confluence with our higher time frame, right? So our higher time frame, we're targeting a 4-hour gap, but on our lower time frame, we're targeting this low resistance liquidity, right? And then also, let's say we have a 5-minute gap above that. Well, we know that we're at least going to come towards that gap. We have a ton of highs we can take out, right? We have that gap. Perfect. That's our low time frame draw on liquidity. We have everything we need now, right? First was our higher time frame reaction. Okay, we got that reaction off of some sort of gap, liquidity sweep, SMT. Now we determined our draw on liquidity, right? We're targeting this hourly gap. We're targeting this high, whatever it may be. Now we want to see our lower time frame retrace. Okay, we're getting the best possible entry, right? We see us pull back into a 5-minute or 15-minute gap. We see some sort of liquidity sweep. We see an SMT, right? Now we're determining our lower time frame draw on liquidity. Perfect. We have equal highs above, and we have a new week opening gap way above that we can go target, right? Same thing. Now, last is your entry. I trade one entry model, and it's inversions, and that's it. If you guys trade another entry model, that's completely fine. Literally just substitute it out into this, okay? Not saying you have to use inversions. I'm just telling you what I use. I would stick to one entry model. When you're discretionarily trading, right, trade one entry model. It's going to be the best for you. It's going to be the best for your risk management, the best for your RR, right? All of that stuff, it's going to stay very similar. Your trades are going to look the same, right? Somebody who trades off a break of structure is obviously going to enter in different places than inversions. Somebody that trades off of displacement is going to enter different trades than break of structure, right? So they're all going to look different. But to keep your RR, to keep your consistency, all of that, trade one entry model. Doesn't have to be inversions, but trade one entry model, okay? That's your last thing. So now we've seen everything, right? We get that inversion, boom, we enter that trade. So stacking confluence now. This is how we rate our trades from F to A+, right? So when we're looking at something, let's say we're looking at our higher time frame reaction. Let's say on our higher time frame reaction, we have swept this low right here, okay? And we've just tapped into this 4-hour gap, and there's a 1-hour gap inside. And then let's say on top of that, we formed an SMT with these lows right here, okay? So that has almost every single one of these checked off in our higher time frame reaction. So therefore, right, that's going to be way stronger of a trade if we end up trading than something if we just had a 1-hour gap, right? So you see how this is where it becomes discretionary, because you're rating trades based off of how much confluence you have inside of those trades. A lot of mechanical models will just be 4-hour gap, 15-minute gap, inversion, right? Something like that. And that's one thing, right? So you're not able to rate those trades. It's very, very robotic, and you're just trading strictly off the strategy. And it works, right? But it won't work forever. Okay, so that's why you have to adapt and trade with discretion, knowing, okay, we have all of these, right? This is going to form a better setup than something else, right? Then you determine your higher time frame draw. Let's say you have a high resting inside of a gap, okay? That's beautiful. That's like most confluence you could get, right? Because you know, okay, well, we can sweep that high and tap into that gap in the same move. Why would we not do that, okay? So therefore, you're stacking confluence again, having both of them, having a couple of them, as opposed to just one or the other, right? And it's the same thing with the lower time frame retrace, okay? Let's say we're in equilibrium. We have an SMT. We have a 15-minute gap, right? We're stacking those confluences up. If we can see that we have every single one of those, holy shit, this is forming to be the best trade of our entire life, right? So you understand how to stack confluence. Same thing with the draw on liquidity. Let's say we have all of that, right? Then going back above, we have equal highs with low resistance liquidity. It's inside of a 15-minute gap, right? Everything like that, that's all stacking confluence. So if we had all of those, boom, that's freaking A+++, okay? But if we only had a couple of them, then you're probably looking down. You're saying, okay, this is maybe B. We don't have this. We don't have this, right? But for you to be able to enter a trade, you want at least one of each of these, okay? It doesn't need to be every single one, but you want at least one of each of these to be able to be confident that we are going in that direction, right? And then obviously you're entering off of whatever your entry model is, okay? And that's exactly how it works. It's exactly how it goes every single time. It is extremely simple when you boil it down to the basics and you're stacking confluence, okay? That's the biggest thing, is stack confluence. You don't want to just trade off of one thing. Look for all of these, Okay, you don't have to use them all, but look for them. If you have them, boom, there you go. That's a little extra confidence, right? If you have a shit ton of these, PD arrays and confluences, then you're gonna be thinking to yourself like, man, this trade is really good. This trade's definitely gonna play out, right? Why would you not want more confirmation and more confluence? Okay, it's as simple as that. So that being said, I hope you took notes over that. We're gonna run over one example of this in the actual charts that happened today, right? I'm gonna show you how we trade discretionarily and how exactly I do this, okay? So first thing, right, we want to see a higher time frame reaction. Well, what are we seeing? Okay, well, we just swept out this low. Okay, perfect. There's one of them. Okay, do we have an SMT with ES? There we go. We have an SMT with ES, right? From this low up to here. Well, there's two things. Okay, so now we have an SMT and we swept some sort of liquidity. Do we have any sort of gap? Doesn't look like it, right? And that's completely fine. We have a liquidity sweep and we have an SMT. Beautiful. Okay, now we're looking for our higher time frame drawn liquidity. Well, this one's pretty easy, fortunately, right? We have like this 200-point new week opening gap here. That obviously is what we're going to want to target. Okay, you guys should know what a new week opening gap is. It's like a stronger fair value gap. Okay, so now we're pairing those two together, right? We just swept this low. We have an SMT with this low right here. Right now we have a drawn liquidity. We have this new week opening gap up above, okay? That's perfect. That gives us exactly what we need, right? So far, this looks like it could be an A trade, right? We know exactly where we want to go. This new week opening gap is pulling us, swept out this low, high time frame SMT, okay? Now we're going to scale down into our lower time frame, okay? Now what are we looking for? We're looking for some sort of retrace, okay? And New York AM session is right here. So this is what I'm going to be talking about, okay? Well, first of all, what do we have? Well, it looks like we swept out this low right here, which is London low, okay? Well, there you go. There's our first confluence. Do we end up having an SMT there? We do not, right? And that's completely fine because we don't need it, okay? So first confluence is that we swept out that low from London session, okay? Next thing we're going to be looking for, do we have anything else that can give us something that we're going to go in that direction, right? We have a low time frame confluence, but do we have anything else that could possibly tell us that we're going to go in that direction? Well, in this case, I do see that we have this 15-minute gap here, right? Boom, there we go, 15-minute gap. Maybe let's scale down. Do we see if we have a 5-minute gap? And would you look at that, right? There's a 5-minute gap inside of that 15-minute gap. Double confluence, right? If you have two gaps inside of each other, you're more likely to go in that direction, okay? Next, what do we have? Do we have equilibrium? Let's check. Boom, there you go. We have equilibrium of the range as well, right? Now, everything is looking perfect. It's all looking beautiful, okay? We have our lower time frame reaction. We have the higher time frame draw on liquidity. We have the higher time frame reaction, right? Now, what do we want to look for? We want to look for our lower time frame draw on liquidity, okay? An example for this, what do we see? Well, we have this high right here, okay? Right underneath that, we have this high right here. Right underneath that, right, we have this high right here. We have three highs that have not been taken out yet in a matter of 5 points, right? So what does that tell us? Wow, we have a great lower time frame draw on liquidity, okay? That's beautiful. Something like that is insane, right? And obviously, the more you guys trade, the more you're going to be able to tell which draws on liquidity are going to work versus which ones are not, which ones are stronger, which ones aren't, okay? You'll eventually get there, okay? So don't be worried about that if you don't understand that part. Now, what's last in the strategy, in the discretionary model, right? We have everything we need. Now we find our inversion, okay? Let's check down in the 1 minute. Now, with inversions, how inversions work, okay? You are going to be taking the time frame that corresponds to what the setup is. Okay, if this setup is A+, take a 30-second inversion. The reason being because the 30 seconds is going to give you the best entry, right? If you're not as confident on that trade, then I would wait for a little higher, okay? Now, if you are a new trader, which you shouldn't be, right? If you're a new trader, however, just take the highest time frame within the 30 second to the 3 minute, right? So if we have a 3-minute inversion, take the 3-minute inversion. If we have a 2-minute inversion, but not a 3-minute, take the 2-minute. If our highest time frame is the 30-second, take the 30-second, right? So in this scenario, you'd be taking this 3-minute. Now, for me, if I were to take this trade, I'd be taking the 30-second, okay? Because this is a beautiful trade. We have everything we need to see. This is A+, okay? Now all we looked for is our entry. And our entry in this case is our inversion. So you're using the inversions depending on how good of a trade it is, right? So if the trade, if you're rating it maybe B+, let's say we have a higher time frame reaction off of a 4-hour gap, our draw on liquidity is a little iffy, right? And let's just say we have a retracement to a 5-minute, but it's not totally in equilibrium. There's no SMT, right? Maybe that's a B+ trade. So therefore, you want to wait for maybe a 2-minute or maybe a 1-minute, right? And that all determines, and that's all based off of how confident you are in the trade, right? So if you're extremely confident, even if you don't have a ton of confluence, if you just have that gut feeling, that intuition, which eventually you'll get, right? To where you're like, yeah, this trade's playing out, take the fucking 30-second, okay? The 30-second is going to give you the best entry, right? The best possible case scenario to enter that trade, okay? So in this scenario, let's say we took this 1 minute here, we'd be entering off of this candle. Now, for stop losses and for targets, those are completely up to you, okay? That doesn't really matter. That's a discretionary play. For me, I go stop losses at the candle bodies, and then I just target that intermediate high that we're delivering off of. This is essentially what I do for my trade. So this trade would have played out in a little longer than we would have liked. Could have targeted this right here if you wanted to, just for a 1-to-1, right? All of that is going to be based off of you and your trading style, okay? But the model, the discretionary model, is all going to be essentially the same, right? You're stacking confluence. You're determining where we're going, right, off of us stacking confluence. So that's exactly how it works. That is a pure just like showing you how, okay? But beautiful example for the discretionary model. This would be A+, this would be rated A+. I would take this trade every single time, okay? But with that being said, that is the discretionary model. That's how I trade discretionarily every single day. Now, I will tell you that the way that I trade, I love fair value gaps. I always, always, always want to see a 5 or a 15-minute fair value gap tapped into. I will not take a trade if we have not tapped into a 5 or a 15-minute fair value gap, okay? That's how I trade. You don't have to trade like that. I'm not saying you have to, right? But for me, for my trading style, for how long I've traded and how much I've put into fair value gaps and how much I understand them, I am going to trade off of a 5 or a 15-minute fair value gap. Everything else is extra confluence stacked on top. In this scenario, right, equilibrium would be stacked on top. An SMT would have been stacked on top, right? This low resistance liquidity back to the upside would be stacked on top. All of that, right, is just stacking the confluence in that direction, okay? But with that being said, that's going to be it. Hope you guys enjoyed. If you have any questions, go ahead and leave them down below. And give me suggestions on what kind of videos you guys want me to do next. Lastly, if you guys want to work with me one-on-one, if you want to get this strategy taught to you specifically in a call, right, personally by me, go ahead and click the link. It's the first link in the description. Apply there. I'll reach out to you and we'll get things situated. But that being said, that's going to be it. Catch you boys later.